Welcome to the Deep Dive. Today we're digging into research frontiers. They license out smart glass tech, and their latest quarter, Q2 2025, was messy.
Yeah.
Really messy. They're the SPD smart glass people. That's the high-end stuff that tints on command. Our job today, figure out if their big revenue drop was just, accounting noise or something more serious.
Okay, let's just rip the Band-Aid off right away. The numbers they dropped after market close on August 7th, they look pretty brutal. The GAAP earnings per share, that came in at a loss of 2 cents, which, okay, isn't the end of the world. But the revenue, that was the shocker.
How bad was it?
Fee income was only $129,900 for the entire quarter.
Wow.
Yeah. That's a 73% collapse compared to last year's Q2. A drop like that usually sends investors heading for the hills unless there's a really good explanation.
And management definitely came armed with one. They basically argued this was a case where accounting optics mask operational momentum. That was their phrase. They pointed to two big things they said were non-recurring, sort of one-offs that skewed the numbers.
Right. What were they?
First, and this seems like the main driver, a European licensee supplying Ferrari went bankrupt, so write-offs associated with that. Second, some non-cash accounting charges, things related to stock options they issued. So their argument is, if you ignore that Ferrari supplier shock and the options charge, things actually looked better operationally.
Okay, that makes sense as a narrative. But how did the market take it? Did they buy that one-time story?
Seems like they were cautious. The stock slipped about 2.6% the next day. Not a huge drop, but it tells you investors are kind of saying, okay, prove it. They want to see that royalty catch-up happen before they fully believe the narrative.
Right. And we really need to unpack that licensee bankruptcy. Was it really responsible for that huge revenue dip? According to management, yes, almost entirely. Because that supplier filed for bankruptcy in Q2, Research Frontiers couldn't book any royalties from them for the quarter. Zero.
Okay, zero. That explains the number. But wait, if a major supplier for Ferrari goes bust, isn't that revenue just gone? How did they reassure people the Ferrari business itself wasn't disrupted?
That's where their whole continuity through disruption strategy comes in. It's actually pretty interesting. They said the transition of supply to another existing European licensee was, quote, successfully transitioned.
So another one of their partners stepped in quickly.
Exactly. And crucially, they said production for Ferrari had already started with the new supplier. So no disruption to Ferrari itself, the OEM. That licensee diversification, it actually worked like they planned.
Okay, that's a key detail. And that quick handoff, that leads right into the potential good news for the next couple of quarters, right? Because of how their royalties work.
Precisely. It sets up what could Now that they're producing this high volume Ferrari glass, every single unit they ship for the rest of the year generates new incremental royalty income for Research Frontiers on top of that base.
Okay. So it's like deferred income suddenly hitting all at once.
You can see it that way. It creates this potential for a big catch-up payment, or rather significantly higher royalty reports expected in Q3 and Q4 this year, a kind of double whammy.
And underpinning all of this is their balance sheet, right? They mentioned stability.
Yeah, that's important context. They remain debt-free, which is huge for a company basically licensing IP. They had about $1.7 million in working capital at the end of June. It gives them, staying power to ride out these low revenue quarters and wait for that catch-up cash to flow in.
Okay, so the accounting might look bad now, but there's a potential rebound baked in. What about the actual business momentum they were talking about? Were there bright spots?
Definitely. If you look past the Ferrari supplier issue, the adoption in luxury cars seems to be genuinely picking up steam.
The big one they highlighted was the Cadillac Celestiq, wasn't it?
By far. They said deliveries of the SPD sunroofs for the Celestiq in Q2 were multiples higher than Q4 of last year and Q1 of this year combined.
Wow. Okay. So that suggests Celestiq production is finally ramping up in a meaningful way.
It really does. And they also noted continued sales to Mercedes and McLaren through the first half of the year. So you see clear momentum in that high-end auto segment.
They also touched on new tech, right? SPD Black.
Yep. A quick update. Said development's going well. Key OEMs are looking at it favorably. That's important for the future, keeping the tech fresh, justifying that premium price.
But the thing that really caught my ear wasn't just auto. It was this diversification push, specifically into architectural glass, a retrofit product.
Yes. And this is where, like you, I really sat up. They're targeting a launch later this year, and the key advantage they talked about solves a massive headache for building managers.
Which is?
Installation. Apparently, these new retrofit SPD windows can be installed entirely from the inside of a building.
Inside, so no scaffolding.
Exactly. No expensive, disruptive scaffolding needed, especially in big cities. That makes it way easier, way faster, and much more appealing for big corporate clients or, say, government buildings. They even mentioned the GSA, the U.S. General Services Administration, which has energy efficiency mandates this could help meet.
Okay, avoiding scaffolding is a big deal logistically, but what about the money? Did they give any projections?
They did, and this is the potential kicker. The licensee specifically targeting this architectural retrofit market, they're projecting sales in the high tens of millions of dollars.
High tens of millions in the first year.
In the first year alone. Now, if you apply a potential royalty rate, Research Frontiers mentioned their current rate is around 15%, but let's say it's 10 to 15%.
Go, do the math.
That single architectural deal could mean somewhere between, say, $4 million and maybe even $6 million or more in annual royalty revenue, just from that one product line.
Compared to $130,000 this quarter?
It's potentially transformative. It could be a massive step towards getting them to consistent profitability, that recurring revenue base they need.
Right. But, okay, we have to talk about the elephant in the room, competition. Because this sounds great, but the stock price doesn't reflect this optimism. Why the skepticism?
You hit it. Competition was a huge focus in the Q&A. The main competitor is PDLC polymer dispersed liquid crystal technology.
And the problem is cost, right?
Massive cost difference. Management was actually pretty upfront about it. They gave an example, the Mercedes CLA shooting brake. For that model, the PDLC option was cited as being 75% less expensive than their SPD glass.
75%. Wow. That's not just competition. That's an enormous price gap. How do they even compete with that?
Their argument comes down purely to performance. They position SPD as the premium high-performance alternative. It offers much better control of heat, light, glare. Remember that 18-degree Fahrenheit temperature reduction stat in cars? PDLC doesn't do that.
So PDLC is the cheaper but maybe not as good option.
Exactly. Management basically described PDLC as more like a frosted window. It uses light scattering. It never gets truly dark or clear like SPD does. They even described its intermediate state as looking like a dirty window, sometimes because of the haze.
Okay, so performance is better, but that price.
It's tough. They acknowledge that automakers like VW, Audi, even Rivian are choosing the cheaper PDLC option for some models, even knowing the performance isn't as good. Price wins out in many cases.
So the strategy is essentially to own the high-end luxury niche for now, where performance matters more than cost.
That seems to be the core of it. Rely on that diversified licensee base to handle shocks, like the Ferrari supplier bankruptcy. Keep winning those high-margin deals like Cadillac, and then wait.
Wait for what?
Wait for increasing volumes, especially this new architectural product takes off, to eventually help drive down the manufacturing cost of SPD. The long-term bet is that the cost gap narrows, and SPD's superior performance becomes undeniable, even for more mass-market vehicles.
Okay, that makes sense as a long-term vision. Right, let's shift gears. It's time for our segment. This is not financial advice. Given everything we've just discussed, that potential Q3, Q4 royalty snapback from Ferrari, plus this architectural product seemingly right around the corner there, looks like a very specific high risk, but maybe high reward setup here.
Absolutely. We're pitching this as a contrarian catalyst play. The market basically shrugged off the Q2 miss with only a small dip. This trade assumes management is right about the reasons for the miss, and that accounting low point actually sets up a potentially huge recovery later this year.
So what's the actual trade idea?
The idea hinges on those catalysts hitting close together. Think about initiating a small but leveraged position, specifically using short-dated out-of-the-money call options.
Okay, short-dated calls, when would they expire?
You'd want them expiring just after the Q3 2025 earnings are expected to be released. The goal is to capture that potential double whammy. The Ferrari royalty rebound showing up, and the first significant revenue from the architectural launch hitting the books in the same quarter.
So you're betting on both those things materializing simultaneously to cause a big reaction.
Precisely. If that royalty income bounces back strongly, and if that architectural launch is real, maybe showing that potential $4 to $6 million annual run rate starts to look credible, then the stock, which has lagged the market badly this past year, could potentially gap up significantly.
And the options give you that leverage for explosive returns if you're right.
But if Q3 disappoints, if the catalysts don't hit, your loss is strictly limited. It's capped at the premium you paid for those options. It's a defined risk, potentially high payoff structure, playing for that catalyst convergence. Low probability maybe, but asymmetric reward.
Okay, so wrapping this all up, what's the big picture takeaway for you, the listener? Research Frontiers is basically betting its whole unique licensing model being debt-free, having multiple partners can win out by focusing on SPD's premium performance, even with that huge PDLC price disadvantage right now.
Yeah, the fundamental question you have to ask yourself is that operational momentum we see, especially with Cadillac and maybe this new architectural product, strong enough to finally overcome that pricing pressure? Or will these one-off issues, like the bankruptcy, keep popping up because they're stuck in these smaller, high-end niches?
We've laid out the numbers, the potential catalysts, the big risks like competition. Now it's your turn to dig deeper. Thanks for joining us for this deep dive.